Welcome to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. We aim to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's video. All opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers.
Hi, I'm John Mark Young. We are now sitting at a 16 out of an 18-week positive cycle for the markets. And this is a streak that if you wanted to replicate it, see when it happened in the past, you would have to go back to 1971 to replicate, which as the Wall Street Journal articulated this week, that was when Three Dog Nights topped the Billboard's 100 with the song called Joy to the World. Quite the impressive streak, and we'll specifically look this week at some markets outside the U.S. that impress us as well as a market rally that, we've had 16 out of 18 weeks now. Does that mean we're too high? What does the 3-year average of the S&P tell us? We're going to look at that. But let's dig into the numbers of the week, and each week we start out with the Atlanta Fed's GDP Now model. As I told you last week, this number did not get updated last week, but we got 2 updates this week with a few pieces of data coming out. And so how did that number look? Well, there was a spending release from the U.S. Census Bureau and the ISM manufacturing report on business. Those were the second half changes of the week. And those moved us from nearly a 3% level last week down to a 2.1%, which, as you can see from the graph on your screen, is quite the drop from last week's number, or the last 2 weeks' number, and almost puts us right in line with Wall Street's economist predictions of where they think the quarter is going to end, at least right now, as it relates to GDP. So a drop intra-quarter is not something we haven't seen in the previous quarters. We actually had that happen last quarter, and then it popped right back up. But with the labor report coming out this week, the jobs numbers, it makes those numbers very important to gauge how fast the economy is still growing. Next, for 2024, we are closely watching the 30 and 15-year mortgage rates as a gauge for giving the economy a little extra juice this year if those rates can find their way closer to 5% and stimulate the pent-up demand in the housing market. This week, the 30-year mortgage continued its climb the wrong way. It actually touched 6.94% for the week, and the 15-year rate did get a little bit of reprieve, dropping to 6.26 from 6.29 a week earlier. Next, to get a front run on the labor market, we like to look each week at how many people are going on unemployment. And that number this week came in at 215,000, so still historically low there. And the continuing claims unemployment number, which tracks those on unemployment that were unable to find work. Thus, they were not able to come off the unemployment ranks. That number actually jumped to 1.9 million. And frankly, each week, we look at the markets, especially as they relate to our 4 Dave Ramsey categories in regards to equity or stock market investing. This week, the S&P 500, which is our proxy for growth and growth in income, but only when taken and considered together, that was positive 0.95%, hence the 16 out of 18 weeks. The Russell 2000, which tracks small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, that was positive, get ready for this, 3% for the week. And finally, the MSCI EAFE, or all the stock markets across the globe of developed countries, excluding the United States, that was positive 0.78% last week. So the aggressive growth category, which our research firm we work very closely with, FS Insights, says, hey, this might be the category that jumps as much as 50% this year. They really, really like that category. But so far for the year, you've only seen a 2.5% increase for the Russell 2000 with this week's 3% jump. So it took them positive finally. First, the S&P at 7.7 and the MSCI EAFE at 3.52 for the year so far year to date. So hopefully more of the same for small caps over the next few weeks. And point number 2, is the stock market due for a correction? This is the common question that we tend to ask ourselves when the market has had such a good run. We just can't be happy, I guess. We can't just enjoy the moment. True, the stock market doesn't go up in a straight line, but also the argument it has gone up, thus it must go down, is not an argument based in truth, especially in light of the average return of the S&P 500 over the last 3 years. 3 years. So let me explain what I mean by 3 years with some help from data from my friends at Data Trek. We constantly talk about most 5-year return periods being a good source of good returns. The stat we often quote is over 80% of 5-year periods, or if you want to even go longer, 10-year period, 95% of 10-year periods are positive for the market. However, what about a 3-year period? Even in a 3-year period, the S&P 500 typically generates pretty good returns. Now, Data Trek tells us that the average 36-month, 3-year, price return from 1974 to now is 29%, which is an average 8.9% annual compounded return. While our data source that we have, you're seeing on your screen, couldn't go back that far, what you are seeing is a look back to late 1990 with rolling 3-year returns on your screen. The S&P 500's rolling 3-year win rate, which is the percent of days with gains over that period, since 1974 is 81%, as I discussed earlier, so comparable with the 5-year return win rate. Negative 3-year holding periods are limited to timeframes with recessions typically, and these are caused by specific crisis level events, things happening. Over the last 50 years, there have been 3 such periods, and let's talk about those real quick. The first was 1974. That was oil shock and a recession happening at the same time. There was 2003, which was the dot-com bubble bursting, a recession for the economy, along with the 9/11 terror attacks, and we had the Gulf War happening at the same time. And then, of course, 2009, which was our great financial crisis. Now, Jessica Rabe of Data Trek always says, a double is a bubble. If the S&P 500 gains 100% or more in a 3-year time period, history says investors should be thinking through that. It might be a time to say, we have had a little bit of a run. As highlighted on my chart, this has happened 3 times since 1990. Come close to it, I should say. Not quite the 100%, but getting well over the 75% you see on your chart. Because of such strong returns in the 90s, when you get to July of 1997 to April of 1999, which unfortunately is what you don't see on your screen here, but the index was often up around 100 to 125% when looking at rolling 3-year returns. This was the longest period that we've had where you had plus 100% returns over the last 50 years. It was a great time to be an investor, but about to be not so great. The U.S. equity market eventually peaked in March of 2000, and it would not bottom until October of 2002, and it was down 50% nearly. Because you're seeing the end of 1999, you technically don't see that 100%, but it was there, friends. And then after the 2008 financial crisis, and then we hit our lows in February, March of 2009, the S&P 500 doubled in the 3 years ending March of 2012. But in this one case, stocks went on to continue to rally. They didn't have that big drawback from the next 7 years. And that was simply because we started from such a low level with the market dropping so hard, particularly in that 3-year period. The last time the index doubled over a 3-year period was the period ending December of 2021. Thanks largely to all the money we spent, the fiscal and monetary stimulus because of the pandemic. The S&P 500 then went down in 2022. We all lived through this, 18% as the Fed just got crazy with interest rate movements to try to beat the inflation game. So as of today, right now, and that's the question, the S&P 500 is up 31% over the last 3 years. It's very close to the long run average I said earlier, which is 29%. So let's pretend that you didn't live through 2023 and the first part of 2024, and you didn't hear me talk about the 16 of 18 last weeks we just mentioned earlier. All you knew about the index was its 3-year return as of today, which is 31%. You would perhaps assume the last 36 months have been pretty routine. And they have, of course, been anything but pretty routine. And yet the index returns look boringly normal. This, in a nutshell, is why Data Trek likes looking at the 3-year returns, because it's showing us that we're not in a massive, massive boom. You're just, in a word, like we talked about last week, normal. Point number 3, the past year witnessed a significant rise in Americans' retirement savings. Hey, that's some great news. According to Fidelity Investments, the number of individuals with $1 million or more, everyday millionaires in their 401k accounts, jumped by an impressive 41% in 2023. This surge, coupled with a rise in average account balances, paints a positive picture for the future financial security of many Americans, hopefully even yourself. Several factors contributed to this upward trend we saw. The stock market's positive performance played a crucial role in it. Anytime you have strong performance from the market, that's going to help. The strong market gains translated into higher account balances for individuals invested in stocks and other similar assets in their 401k plans. And it highlights the importance of you having a long-term investing strategy. Staying invested through market fluctuations like 2022, we just talked about in point number 2, as time in the market is often more beneficial than trying to time the market. Be in the market, don't try to time the market. However, the story goes beyond just market performance. It wasn't just all such a great year in 2023 driving these results. The report also revealed that 37% of 401k savers increased their contribution rates. That means they started putting more money into retirement. This increased commitment to saving further fueled the growth in their account balances. So it wasn't all performance, it was actually the fact that presumably people were being better financial stewards. It's important to remember that while market performance can significantly impact your 401k, constant and consistent contributions are equally essential for building a healthy retirement nest egg. It all comes back to Aesop's fable, the tortoise and the hare. You have to be like the tortoise, consistent. Looking ahead, experts believe that these positive trends are likely to continue. Fidelity's report emphasizes the importance of patience and consistency in managing your 401ks. Some of the best 401ks at Fidelity were those people that were passed away. Why? Because they were patient and consistent. They couldn't do anything. While there will inevitably be periods of market volatility and long-term potential for growth is still going to be there. This highlights the value of seeking professional guidance and developing a personalized investment strategy suitable to how much risk you're willing to take and want to take and the retirement goals you have. But as we see here, just being invested has typically provided investors a great path to an everyday millionaire. The rise in 401k millionaires and average balances offers encouraging news for American retirement savings. By combining the benefits of a strong market with increased contributions and sound investment strategies, growth and income, aggressive growth international, in our opinion, individuals can take control of their financial future and secure a comfortable retirement. This point only proves to highlight the fact that Dave Ramsey's baby steps, or some semblance of sound financial planning, should be followed and executed over a long period of time. These everyday millionaires that Fidelity highlights, of course, and we're just talking about their 401ks, we're not talking about their house equity and other things, but it just highlights in the studies that this did not happen by accident. And my guess is most of them have lived lifestyles where this money will not be completely used, thus changing family trees and nonprofits for generations because of their wise stewardship. If you long to be a biblically wise steward today, get the resources of Dave Ramsey or go listen to Rob West's Faith and Finance show and start your journey to biblically stewardship today, friends, because it's not impossible. And finally, point number 4, depending on the portfolio your advisor has allocated you to at Whitaker-Myers Wealth Managers and the size of your investment, you've probably seen specific Indian-based investments or India-based investments being made into your portfolio. This is because based on our data points we pay attention to and the research that we actually purchase and do ourselves, the Indian economy is displaying promising signs of a major boom in the coming years. But this week, we actually got a report by Morgan Stanley that predicts a remarkable trajectory, with India potentially becoming the world's 3rd largest economy by 2027, surpassing the big and established economies like Japan and Germany. This optimistic outlook is fueled by the projections of more than doubling their GDP, reaching a staggering $7.5 trillion by 2031. The stock market is also expected to join the growth party, with the Bombay Stock Exchange aiming for a market capitalization of $10 trillion within the next decade. The bullish outlook isn't just theoretical. India's economy recently surpassed expectations, achieving an impressive 8.4% growth rate in the last quarter. This strong performance is further bolstered by a surge in interest from multinational companies we've talked about on this video series and heard, Apple and Tesla to name 2. These corporations are seeking alternative manufacturing locations and are increasingly drawn to India's potential. The Indian government is actively aiding this trend by investing in infrastructure development and facilitating land allocation for factories so that we can build these, making the country even more attractive to foreign investment. So they're not doing this for just theoretical reasons. There's practical reasons. The government's actually helping in this case. Several key factors are expected to drive this economic surge. The rise in global offshoring presents a significant opportunity for India to attract manufacturing business. Additionally, the nationwide digitalization initiatives aimed to enhance economic efficiency and foster innovation will also help. And finally, a focus on efficient energy transition could pave the way for sustainable and competitive growth, solidifying India's position as a major player in the global economic landscape, and one that we are very excited at Whitaker-Myers to have allocated to for nearly 12 months now. One that we fully believe in this Morgan Stanley study that India's economy is one to watch and more than likely, depending on your risk tolerance, your goals and objectives, possibly be invested in. So talk to your financial advisor today if you would like an allocation to the Indian economy in your portfolio. So thanks so much for watching the 4 things we learned in the markets this week. If this video series was helpful to you, would you do us a favor? You can do us a favor by hitting the like and the subscribe button. The like button helps us with Google and Rumble's algorithms, and YouTube, I should say, to push our content out to more people. And the subscribe button allows our content to be pushed to you as it's released, so you can be one of the first to watch it. As well as you can go to the comment section of this video. In the comment section, there will be a link where you can schedule with any of our financial coaches who help you in baby steps 1, 2, and 3, get out of debt, stay out of debt, live debt-free, and meet with our financial planners and advisors in baby steps 4, 5, and 6, so you can build out that retirement plan, so you can be like one of those Fidelity folks we talked about in point number 3, and also help make sure you're saving for kids' college and get that house paid off over time. So you become a millionaire, everyday millionaire, before your 401k hits it, because you got a paid for house. So thanks so much for watching. We'll look forward to seeing you next week on what we learned in the markets this week.